Welcome. Alicia Castillo-Goli here at the Wealthing Institute. We are living a historic moment. In years to come, whatever it is that we did and we didn't do during the coronavirus pandemic is going to define who we are like nothing else. So we at the Institute decided to get together and provide the best tools that we can find for individuals. And we are developing 3 webinars. A webinar about being an angel investor, a webinar about mastering your life, and a webinar about pivoting your business. These are tools that we've developed over years and about overcoming the several crises that we have had to live. We hope that by doing that, we're going to contribute to your personal and professional development. In this particular webinar, we are going to talk about angel investing. Let me share the screen and let's get started. Angel investing is about diversification, impact, and return. Very few people understand why individuals would give up some of their money and their contacts and the content and the competence and their support to other individuals that are not related to them. So I am very fortunate to be an angel investor, and I'm being very, very fortunate to receive the support of other angel investors that make me a much better person and a much better professional. This talk is divided in 3 parts. The part 1 is about the investment strategy. As an investor, why do I want to be an angel investor? The second part is about how does it fit with a funding strategy. And we're going to look at it from the supply of capital side, so from the entrepreneur side, from the business that is requesting the funds. And the last part is about how do we execute? How do we integrate and start becoming an angel investor? Unless you have been born in a family that has done that, chances are that you're not very familiar with that, and it could be a little bit overwhelming. So let's start with what is angel investing. Like any investment vehicle or mechanisms, angel investing considers time, the time that you get to receive a return, the risk that you take, and the return that you are expecting. Many people think that because it is high risk, it should have high return. It works the other way around. Because it is a high return investment, you are assuming higher risk. So it's not that you go around saying, oh, I want to risk my money so I can have a higher return. No, it is the other way around. Because the potential of the return is so high, I want to take more risk. But there are other things that are not capital based. Let's see. We invest our money and time supporting companies that do not qualify for any other type of resources or funding. That's what we do. We support companies that otherwise can't get funded. And this is a critical part of what we do for the benefit of society plus our own benefit. We collaborate, we create new wealth. We put our own capital. And I'm not talking only about our money. We put our time, we put our contacts, we put our intellectual capital. Oh, I learned how to do this when I was working in this industry. Oh, you know, this person might be able to reduce your risk because we're going to ask them some questions. This is like free consulting. We are here to support companies and to support entrepreneurs. We also make our own decisions. So to do that, we develop what is called an investment thesis. And traditionally, angel investors start investing in areas that they know a lot of. And then they go and then they can be a little bit curious. I invest a large portion of my angel investing in companies that I know very well, life sciences, a little bit of engineering, and a little bit of software. And then I also invest a little bit, just a little bit, to support companies just because I'm very curious about what they're doing. And I like the entrepreneurs. And I'm taking higher risk with those because I don't know. exactly how to support them. But because I have this other knowledge and I can translate that to this company, I am able to be very creative in supporting them. We want to make money, but we want to do it wisely. We want to contribute and we want to be appreciated. We don't invest, as I said, because it's risky. And we don't invest because we want to speculate. We invest because we believe that we can make a difference. And the whole purpose of angel investing is to part ways and be happy about the time we spend together. Unlike other equity partners, we don't intend to be in the business for a long period of time. And we'll explain that a little bit later. For now, you have to think that we have a very intense and time-constrained relationship with the entrepreneur and the businesses that we support. But let's get back a little bit to see what is investing. So investing is not a thing that actively managing our assets to create a higher return. For example, when we go to higher education, when we take a course and we educate ourselves, we're managing our time and our intellectual capacity to create a higher return in the future. And sometimes that return is measured in money, but sometimes it's measured in personal satisfaction. So to think about investing only in terms of financial capital, it's pretty limiting, because in reality, we invest our intellectual capital, our capacity to think and to create new worlds and to participate, our production capital, our capacity to get things done, our social capital, our relationships, our connections, our friends, our co-workers, and our spiritual capital, our capacity to feel that we have made a contribution to the world. And we do all of that because we want a better future and because we want to be responsible for ourselves when we can no longer work or take care of ourselves. So we sort of accumulate all that capital to benefit us and others, so others don't have to take care of us. So it's a combination of not only financial rewards, but a lot of other rewards. Many years ago, when we were going through the global financial crisis, I wrote a book called The 10 Unwealthy Habits. And the way I structured that was very interesting, because I told people, stop doing these things. Not just do these things, but stop, take the feet out of the brake so you can move forward. And one of the things that I said is that when you have financial capital, you should always save some when you start earning money. So try to operate with 70% of your cash, and then use the other part to save, to enjoy, to donate, and to invest. So you have a range of that, but try to live that is living beyond your means, below your means, not beyond. And when you do that, you just have more freedom, and you think that you're not at the mercy of the cash flow that is coming in. So those things that I discovered in the last financial crisis are very applicable today. When I was a kid, we were talking about the cigar and the ant, and one of the insects was always singing and the other one was always saving, and then the one that was always saving was saving the other one when the winter came. So it's pretty much about not only saving for yourself, but also about creating these healthy relationships that help you go through the hardships when they come, because chances are that they will come. And angel investing fits into a lot of different categories. So if we are investing our capital to create a better future for ourselves and to be responsible, then we have to see what is our goal. And our goal for our investments have to consider three aspects: the return, how much do we give and how much do we get back; the risk, how much can we lose; and the time, how long do we have to wait. And then with all these things, we create a portfolio. And these on the left side here are examples of investment mechanisms: the public stock market, the currencies, real estate, term deposits, your pension, alternative investments, mezzanine investments, something, real estate, savings, commodities, metals, agriculture, energy. I hope you didn't invest in oil because it dropped. And private stock, which is your companies or the companies in shares that are not sold to the public in public markets. I'll give you some examples now. So in all of these, you go to the web, you speak to your financial planner, and there's tons and tons of possibilities. But what very few financial planners know is how to help you invest as an angel investor. And the other thing that happens is angel investing should be a tiny, tiny portion of your overall portfolio. But that tiny portion, you can lose 100%, or it has the capacity to create an immense amount of wealth. And this has been working like this for decades. This is exactly the way I convince some people to give me their funds and their contacts and their talent and their competences and their support to create Chile's first seed capital fund. And it's so valid today. So from everything that you have to do, that you want to do to create a better future for yourself as an investor, make sure that you allocate a little bit of your portfolio, which should be less than 5%. To support other entrepreneurs in pursuing their dreams. This is not a donation, by the way. So this is an example of my portfolio. So in my portfolio, I have a little bit of real estate. I have pensions too. I have a lot of stock. So this is more than 55% between real estate and portfolio. I have bonds. I also have my own companies. I'm a limited partner in 5 VC funds, a little bit on the risky side, but this is an area that I know extremely well. And I have art. I have art pieces because I like art, but some people might not like art. Some people like to have a collection. Some people have cars. And I have my own angel investings. And this is this little piece that stacks up there. So when you're thinking about being an angel investor, you think about your whole portfolio, not just, I'm going to go and put everything in one piece, because you want to have a balanced portfolio to manage the risk. The more risk adverse you are, the more diversified you need to be. That's a critical concept in managing your portfolio. And if I were to put $10 of my portfolio, if I could bring it to $10, this is how my portfolio looks like. Now, everybody has different things, but this is what it looks like. So let's think that these $10 are like 100%. So I have 2.63 is in real estate, 3 are in growth, bonds are 1.2, 6.6 are pensions, IRA in Australia. I have CDs. I have 3 companies. One of them is a hotel. And I have some money in commodities. I have some money in art, as I mentioned, and I have some money in funds. But I have a little bit of money on angel investing. And here's the thing. If I lose this completely, I'm going to lose only 5% of my portfolio. But if I spread my angel investments through many investments in companies or through many companies, then the possibility of losing all of that is very, very low. But the possibility of losing one is very, very high. So I can lose 100% of what I put in, or I can make 50 times or maybe more what I put in. So this is the way it works. Now, I made this presentation in January. We are in April 2020. 3 months ago, the expectation was that the stock market could drop 8% or it could grow 12%. It actually dropped 28%. And in some cases, it dropped 35%. companies like airlines, they were oil, gas, they were just suffering, hospitality, suffering a lot. So even though you assess the risk, you realize that the risk that you assess when you have an event that is extraordinary has to be recalculated all the time. And but there's a big difference with angel investing. And here it is. Where can I influence the result? So as an investor, I don't have the capacity to influence the results of my investments. Only in these three asset classes. In real estate, it's not that I can choose where to buy or how to sell, because sometimes that is out of my my possibilities to influence, but I can choose if I'm going to have an improvement. I can choose if I'm going to let go of something. I can choose if I'm going to add a room. I can choose if I'm going to renovate. Those are things that I can do that are 100% in my control, that would have a direct influence in the value that I create. In my own companies, I can choose how do I manage my companies so I can influence the result. And in angel investing, I can choose how I support the entrepreneurs so I can influence the results. In the case of stock market, I cannot influence the results. I can pick, but I pick winners. In the case of angel investing, I co-create the winners. That is a big difference. In the case of bonds and pensions and commodities, maybe in the art case, I can choose one over the other, but there's not really much that I can do for an art piece that is going to increase or decrease its value. Yes, I can burn it, but my capacity to influence the outcome of my investments is limited to few asset classes. And that is why angel investing is one of the most exciting investments options that anybody can make. Now, if we also analyze that with different scenarios, we can see that if this is my cost basis and I make a bad decision or something happens, this can be reduced. In the case of my own company, it's very difficult that reduces in value because I can sell the company. But having said that, the restaurants and the hotels and some of the rental properties are really suffering. We never expected that to happen. But in the case of the stock market, we never expected this to happen. So the risk just goes way out of boundaries here. And some companies go up, some companies come down. Everybody's actually suffering now with the coronavirus. But in the worst case scenario, I can lose all my angel investments. But in the best case scenario, I can multiply that 5 times. And that is a real possibility. And that is one of the many reasons why I would like to encourage you to consider becoming an angel investor. But let's do a little bit more. Angel investments are tools for transformations. Yes, there's high risk, but there's high growth, there's high impact, there's high influence. There's nothing more empowering for you and for the economy than to go and brag around the things that you've invested, the things that you've supported. I supported an indie conference for video game developers that they have no other ways of being shown to the public. I supported a company that creates, that sells electrical panels for people who are not connected to the grid. And it's called Angasa Technologies, and they turn from a pure seller into a financial organization. And now they can allow people that would have no access to electricity. Now they can track their credit history. I invest in companies that are going to print organs. I've invested in companies that are changing the way we sell things or we recycle things, or that are creating plant-based shrimp substitutes, or that are creating something that has immense value in so many ways, Software that allows us to be more efficient, changes in the way we talk about our body, we take care of ourselves, we eat, we support each other, technology, automation in cars, a robotics company. There's so many companies that are changing the way we live and are transforming society. And that is one of the key benefits of being an angel investor. So you have the return, but you also create jobs. You also help increase the taxes, because these companies have sales taxes, income taxes, the jobs that they create generate taxes. So society benefits. You support innovation. You get prestige. It's so prestigious to say, you know what, I was an early investor in Airbnb, which I wasn't, by the way, but it's very prestigious. You support growth. You're engaged with something new. You don't have to do the work of the entrepreneur. That's one of the things that I like the best. And you create a sense of belonging. You belong to a community that is very unique, because there's few things that are more beautiful than putting your hand in your pocket and telling an entrepreneur, I believe in you and I will help you grow your company, which is one of the reasons why angel investors need to know what they're doing, because this is not the way of giving you a checkbook, I believe in you, call me in 10 years. That's not the way to do it. And so I want to share with you two cases, one in the US and one in Chile. And this is an example of a great return. Sometimes it doesn't happen, actually. These are the outliers, but this is the reason why a lot of people should and want to invest as an angel investor. So this is a case of a company that came to for early investments for a seed capital run, or pre-seed, actually. This was a pre-seed. And if you invested, and this is a case here. So you invested 10,000, and then the year later, the company continued to grow. You invested 30,000. And then they generated enough revenue to keep growing and keep growing and keep growing. And then they needed some more money to take the spike to go public. And once they were doing that, another company came and purchased them. So you invested another $50,000. By year 7, the result was $19 million. There's no other legal way of making that amount of money. So this is why angel investors want to be part of this game. And on top of that, the company decided to pay $1.5 million in dividends to the existing investors and to the employees. So this is a great, great case. It's a real case. It's not Facebook or Airbnb, and which made much more money. But these are cases that are absolutely possible for people who want to come and play as an angel investor. But if you see, you have to wait several years in order to get the return. Oops. And this is another case in Chile. This is when I was managing the seed capital fund, Capital Semilla, and this is in Spanish, of course. So this was a company that came, and we invested $90,000 the first year. And the second year, we invested $50,000. And the third year, we invested $100,000. And we structured the model so the CEOs and the executive teams had access to the shares. And instead of having bonuses for the way they were working and for success, we put all of that into the shares, and we paid dividend. The company was a big dividend paying company. We had an offer to buy the company in year 17, but we didn't take it. This company has consistently made money for the investor. Every year it's a cash cow. Every year it makes money, makes money, and makes money, and makes money. So by the year 18, and the company is still working, it had 8 offices in 8 different countries in Latin America and 60 employees. So not only you made money, but you created a service that was very unique. And then you also created jobs that they would not existed any other way. So this is why we want to invest in companies, and it happens everywhere. This is a case of dividends. The other one was a case of selling shares. Now, how does this fit with funding? When you're going to put your money, your own money into a company, there are two paths that companies follow. One is a non-VC, VC is venture, non-VC path, where the first traction of the company is funded by the founders. And then you are making the bridge between the founders and loans, because the company is going to be stable and it's going to start paying you dividends, like the second case we saw. Another possibility is to go the VC path, which is you're making the bridge between founders, family and friends, and venture capital funds. That is what you do. You make that bridge between those two areas. So you either have a very stable company that pays dividends, and that's a non-VC path, and angel investors bridge founders to loans, or you invest in a company that is going to grow exponentially and you're going to sell your shares. So your return is on the value of the shares, maybe dividends, but it's on the value of the shares. That was the first case. And you make the bridge between founders, family and friends, and venture capital funds. So those are the two main paths. But this is what it looks like for the company. Every single work that I see, every single one of them, talks about the financing life cycle. Now, I know that funding is a process. It's not a series of one event, disconnected from the other. It is a process. And in theory, everybody tells you that funding curve is always successful. But if you're an entrepreneur or if you're an investor, you know that that's not the real curve. You know that you go in the early stages when the risk is very high, because you need to understand the market a little bit better. You need to create a team. Sometimes the teams, there's a friction. Sometimes the market changes, like now. Sometimes you don't get funded. The sales cycle is too long. Your product failed. They didn't like the color, or these other software fail. So you have a lot of problems. It's like a baby. You have to change diapers all the time, and you never know when the next poop is going to come, but you know it's going to come. So in theory, they say, oh, you do this and then you grow, and then you do this and then you grow, and you don't do this and you don't grow. But it's like assuming you learn to run without ever failing, and that's not the case. And throughout all of these processes, all of these stages, you can always close the company, so there's a real risk there of closing, and you can always be acquired by another company, or you can merge. But this is what the real curve looks like. So for the entrepreneur, it is like a roller coaster. You think, yes, we got it. How many times have I thought that I got a deal and the deal falls through? How many times have I had to check and I go and deposit and it doesn't work? It's not the majority of cases, but it has happened often enough to make me realize that in reality, the curve of funding is a roller coaster. It goes up and down, up and down, and up and down. And what you want is you want a partner that can help you manage these valleys here that happen along the way, so you can ease the transition, or you have enough cash or resources, because sometimes you don't have cash, but you have a resource to partner with somebody else so you can get things done. And that is when the contacts and the social capital becomes really, really important. So this is how angel investing works. Because it's not debt, you are constantly supporting the entrepreneur through the hardships. When things go well, then they go to VCs. But when things go bad is when you have to go in and pitch in and be the supportive partners. But you don't go in saving them from the get-go. At the get-go, they have to show you that they have a business plan and they respect you. That is also a consideration that we're going to talk about when we talk about execution. So I hope I've convinced you that this is the way to go. But how do you start investing? Because chances are that you don't know. It's difficult. I didn't know. And most people that I know don't know. So you pretty much have three options. You go solo, which a lot of people are doing. You invest in your friends. That's not angel investing, by the way. That's friends and family. You go jointly, and there's two options. We're going to talk about that. Or you do it remotely. That is at arm's length. Let's see how these three possibilities, let's explore these three possibilities. So if you are an accredited investor in the US, that means that you either have more than $1 million in net assets, not including your primary residency, or you have $200,000 on annual income for the last 2 years, and you expect to continue. If you're married, it's $300,000. So those are the rules. Every country has different rules, including not having a rule. So there are countries that have no rules. So if you want to go into angel investing, you can do solo. You start creating a process. I'll tell you all the different steps. You start creating a process, you start evaluating, you invest in companies, and you support them. But what is the problem? It's hard to manage. It's time consuming. I probably invest in 1 or 2 companies of every 100 that I see. So it's hard to manage. You require some competence that is very different to any other form of investment. Your risk is concentrated because in order to make an impact in a company, you need to put enough money in that company. So a company that needs $50,000 or $100,000 might be a first investment, but chances are that they need a little bit more. And chances are that you're not going to have that much money. So if you only invest in one company, that's too risky because the rate of failure in that company is up to 30%. It's not 80%, it's up to 30%. So that can be risky. Also, you have low liquidity. What does that mean? That if you need the money that you invest in the company, you're not going to get it because the company has spent the money to grow it. And although chances are that the value of the shares continues to grow, you don't have anybody to sell those shares because you're not in the public market, you're in the private market. And it's long term. Sometimes it's 7 years, sometimes it's 10 years, sometimes it's 12 years. And it could be nerve-wracking because you go up and down, up and down. It is worth a lot, it is not worth a lot. So those are the things that happen when you go solo. If you go solo as an angel investor, make sure that you're well prepared. When you go with others, and I love an Arab saying, or somebody said it's African, but I learned it the first time in Saudi Arabia. They go through the oasis in the desert, and they have a saying: if you want to go fast, go solo. If you want to go far, go with others. So this applies to angel investing. You are better off, if you want to be an angel investor, joining a group. And you have 2 ways of joining a group. You become a member of a group, or you join a syndicate. And I'll explain that in more detail. And in the benefits and the pros and the cons is that you collaborate. You have mixed liquidity because sometimes you can sell your shares to other members. But it's also long-term. But it also gives you a lot of networking opportunities. And the amount of work that you personally have to do is a little bit lower. But sometimes you have to pay fees. And actually, all the times you have to pay some fees either to join or to participate. You can also be a limited partner in a VC fund. I'm a limited partner in 5 VC funds, and I used to run one. But when you're a limited partner, you trust the CEO or the general manager of that fund, and you trust their competence in their capacity to attract the best deals, to negotiate, to support them, and to exit. So you give them your money so they can do that. But you don't participate in the decision-making process. It has high administration costs, between 2 and 2.5% every year of the capital committed, has low liquidity. And the good thing is that it's a distributed risk. So a micro VC will invest in around 10 or 15 companies. They have a time limit of 10 years, usually with 3 years of grace period to sell the company. But you know that at the end of those 10 or 15 years, you're going to get your money back with some return. And you share the return with the owner of the VC fund, or with the manager of the VC fund. If you go solo, these are the activities. You attract companies, you evaluate companies. Attract is you tell everybody you're an angel investor and you go to events and panels. That's the fun part. It's like dating. You get all excited. Oh, this person, and I like that. But then you evaluate, then you negotiate, and then you execute. That's the legal part that is expensive. You invest, and then you continue supporting and exiting. So you do all of these activities here so you can get in. And then once you get in, you support the entrepreneur as they continue to grow. And then at some stage you exit. But if you're a solo angel investor, chances are that you support them until they get funded by a VC fund. And then you become hands off. And then in the future they invest, but they continue telling you how they're doing. You can also join a group. And these are, at least in Silicon Valley, these are the 3 most prominent groups. St. Hill Angels, where I'm a member and I'm a board member, Band of Angels, and Life Science Angels. There's many, many groups. But what do you need to do to join a group? You have a setup fee that is between $4,000 and $10,000. You have an annual commitment to invest around $25,000, sometimes it's $50,000 per year. And you commit to put in some time, which is 10 to 100 hours per month, and they don't pay you for that. The risks are uncertain because most of these groups invest in early stages, and early stages are pre-seed and seed, where they're still defining the market, and the team sometimes argues, and sometimes the team doesn't work together, and sometimes they have to move offices. So it is higher in risk than if you invest in a syndicate or if you invest in a VC. So it's a little bit earlier, but it's less risky than going solo. The early rounds are usually less than $1 million. Sometimes they're very small. Sometimes it's like $200,000. But if a company needs $200,000 and you're solo, you can co-invest with others. Most likely you will, but then you have to put 20 or 50 or 100,000. If you join a group, you can spread the risk because you can say, I'm going to put $50,000 a year and I'm going to make investments in 5 companies or in 10 companies, depending on the group. But that is much better than putting $50,000 in one deal. So that is the difference. The losses occur early, so you know pretty quickly if that company is not going to make it. So even if you put a little bit of money, you might risk that money, but if the company goes well, they go to another round, and then you put more money in the other round, and then they come back for another round, and you put more money in another round. And that's where you start hearing Series A or B or C or D or E or F or pre-IPO or mezzanine, which when they're going to sell the company or things like that. But if you lose money, you lose it early, and the amount of money that you lose is usually lower because you start putting a little bit of money because the company asks for just a little bit of money. And the gains take time, usually around 10 years or a little bit more, and takes further rounds and further rounds. So that's what it works if you join a group. But the networking opportunities, the learning is extraordinary. I really recommend that you go and check groups that exist around to see if there's one that you might like to join. You can also talk to a syndicate. And a syndicate is nothing else that having an investor or a consultant that sees an opportunity of a round. A round is an investment, an investment time defined round amount of money that they need to go from one A to B. So usually, at least in Silicon Valley, we co-invest. So you can have 2 or 3 VC funds or 2 or 3 angel groups. To fill that round is $2-3 million. So instead of having one group, you have 4 or 5 groups. And then there's a little piece that is left over. And these people who are very well connected say, okay, let me try to raise money to participate in that round. And they create a special purpose vehicle. It's relatively new. I did not hear about SPVs until I think 2018. So it's very, very, very new, at least to me. So what are the benefits? Is that they pre-select the companies, so you don't have to take care of vetting the company. They already have the best company. Your involvement is very little. Sometimes you don't even know the entrepreneurs. Most of the time, you don't talk to the entrepreneurs at all. When you join a group or when you're a solo angel investor, you do know the entrepreneur. And they charge an administrative fee and a carry. That means that depending on where you are, it could be between $8,000 and $12,000 for each round that is distributed amongst everybody that invests. And they take 20% of the profit. That is customary. Sometimes it's 30, but what is normal is $8,000 to $12,000 an administrative fee and 20% of the profit. And the key is to find a leader that has the competence and the experience that could tell you, this is why I like these or I don't like this. That is the key when you join a syndicate. Usually this is just amongst friends. So you can also find them in Republic or Crunchbase or Angel.co. So these are websites where you have syndicates, and but usually people know you. That's why they invite you to be part of that syndicate. So you need to do a little bit of networking there, but you don't get to talk to the other investors, whereas in a group of investors, you do. The other option, which is like the, arm's length, is to be a limited partner in a VC. And when you are a limited partner in a VC, you have to have a minimum commitment. And usually it's $250,000. If you have a family office, it's usually $1 million, or an institution. You don't put that money all the time at once. You don't put the money at once. They call the capital when they need the money. So the way they work is that you have 2.5% of the committed capital that you pay them in administration fees or management fees. And you pay them every year and you pay them up front. So it doesn't matter if they've used the money or not, because they need to do their work. They need to get paid. And so if they start negotiating with a company and they find a company that they want to invest and they sign the deal, then they send you a note and say, hey, we need you to come and give us, I don't know, 10, 15, 20, $80,000 because we're going to invest in this company. But you don't have any say in the companies. You can refer some companies to them, but you don't have any say in their process whatsoever. You get a note every quarter or once a year or twice a year saying, this is the companies we invested in, this is how they're doing. And there's tons and tons of them. This is an example here of small VCs. You have to be a millionaire because you have to be an accredited investor, but you don't have to have zillions of dollars to participate as a limited partner in a VC. They have a carry, which is 20% usually, is a share of profits, and it's usually 30% if they multiply their capital more than 3 times. So it's 30% over that extra layer, and they take 10 to 12 years to exit. They can't be there on a long term because they have a fixed time that they need to stop. But the problem with being a limited partner in a VC is that you have no influence and you have no deeper knowledge. And you might get a little bit of networking, but not a lot. So that is part of the problem. You don't learn how to invest in companies through VCs unless you are active and you participate in that. The other benefit with being a partner in a VC is that because they invest in 10 or 15 companies over the course of the fund, you will make money because chances are that not all of the companies are going to fail. So again, you have the early fails, and the other ones, they continue to grow and continue to grow and continue to grow. But the reward for the managers is tied to your profits. So that's how you get that's how you get to work the system for both you and them. So what happens after you invest? Well, there's 4 options. What happens to the company? If it goes bad, you lose the money. They close the company in 1 or 2 years because chances are that they don't raise money anymore. So they have no way to sustain the company. Sometimes they sell the company early. Sometimes they manage to sell some of the assets. So I've had investments that I made where the company can't raise more money and they sell the technology and they distribute that money to the investors usually. So maybe you make, 10 cents on the dollar or 20 cents on the dollar. Sometimes you don't make anything, you lose it all. If it goes well, then they come back for more money. So you don't get a quick fix. If it goes excellent, then the company is acquired. So I have one of the investments that I made was acquired within 4 or 5 months, and it gave us 45% return. But I think if we had waited a little bit more, they would have been better. So you have all sorts of things. Now, the ones that go so-so are terrible because they can't grow, you can't really help them, but they can't fail. So they're like in that limbo phase. And sometimes they find a way to pivot and sometimes they end up closing down. But, it doesn't, it's like money that is there, but, if you lose money, you can take some of that from your taxes. But if it's just stable there, it doesn't do anything. So those are the options. So it goes bad, goes well, goes excellent, and it's terrible. Now, if you want to be an angel investor, what are the things that you need to do? You need to separate your activities in 2 sort of mindsets. The first one is, how do you start? So when you start, this is your mindset. You have to have an investment thesis. What is the industry that you want to be in? What is the region? What type of entrepreneurs you like? And you just sit down and you elucubrate what it is that you want to do. Because, if you don't know where you're going, you can't plan, and you never know if you got there already. So you need to plan to become what you plan to become. And then just focus on collaboration. There's a lot of people that would give you a hand when you're starting as an angel investor. You evaluate. Nobody makes a decision for you. You make your own decision. You learn, track down what you're learning, take it like an academic course. You support the entrepreneurs, and you have to resist telling them what to do. This is like managing a teenager. So you don't tell them what to do, you tell them your opinion. You open doors for them, and you encourage them to take positive actions, but you cannot control those actions. And you have to resist getting angry at them, because it's really hard to maneuver the companies at that stage. And then if you keep doing that and doing that and doing that, from probably the year 7 onwards, you start exiting. And then you feel more comfortable, you can lead, you collaborate as well. But in this instance, you're not learning, you're leading, you're teaching. And you just enjoy the rewards from that. So the whole purpose of angel investing is that you'll start making money of your investments, and you can reinvest that money. But because the amount of money that you make is exponential, it's going to have a big impact in your portfolio. And I'm going to give you some real examples. These are part of my investments. This is not the amount of money that I put in, but the amount of money that they were raising. So you have 3 completely different companies. This company went up, this company went up, and this company went up and down. So you have all these different types of options. This is why it's so important to collaborate, because there's a lot of skills in this. So this is a Series C, this is a convertible note. You have series A1, A2, A3. So it is much better when you can talk to somebody to help you navigate through this. Why is this a good investment or not? So this company right here, actually I invested here and I invested here. I did not invest here. They're coming back and they are going to be, they're starting to think about being acquired. So when they're going to get acquired, they're probably going to go up again. So these are my companies, the companies that I invested in. Some of them, many. I've invested in 20, 24, 25. Now, and these are companies that I lost money in. So as you can see, I always start with a little bit of money. I don't do the first investment. I don't do large amounts of money because I know that if they don't go well, they'll come back for more money. And I don't have that much money. So that is a great way to start. You know, you join a group or you join a club or you syndicate. I prefer to join a group. And I have my own investment club now. But you invest a little bit of money, and my life is not going to change dramatically if I lose this amount of money. But I have made so much more money in the other businesses that are doing well that I will continue to take this risk because there are a little bit of risk. There's not a lot of risk. And you have to think this is the one that went up, went down. So the post-money valuation went from 23 million to 11 million. They shifted from one market to another market. And you have to think for yourself, you know, that at the end, everything is fine. If it's not fine, it's not the end. And sometimes these companies will close. That is why this is high return, because you are also taking high risk. You don't want this to happen, but this is a possibility. And the last thing that you can do is pull the trigger and let the company go free fall down. So sometimes we go back and invest again to give them a little boost because they needed to change something, or the market changed, or there was other opportunities, and they need to change. They need to pivot, or they need to change. And when everything goes well, like this one, so this is a company that I bought, I think I bought this at 33 cents. And the last time I invested in them was in 2 years ago. It was 5.8. And I think they had another round of $18 that I did not participate because it was too much money for me and I wanted to put more money in early stages. But if you can imagine, I've already enjoyed all this amount of wealth from just this one share. So how do you compare the different things? Well, you can have limited partners or VC funds, individual angels, angel groups, special purpose vehicles. And I have an own club that you don't have to join us, but this is just a comparison. So sometimes you put some money, sometimes you have management fees, sometimes you have other fees. You always have to pay a little bit for this. And sorry about this. And you have carry or you don't have carry. There's no free lunch. You either do the job, do the work, or collaborate and help paid for the work that somebody else is doing. And these are the average numbers of investments, and investment per person is between 100 and 200,000. But you can have small investments of 5,000 or 10,000. And then you have different sizes of investments. Now let's see in terms of activities, sometimes you have to do the work, sometimes you have to piggyback on somebody else to do the work. So if you're a limited partner, as I mentioned, it's very passive. If you're an individual angel, you have a ton of work to do. And you usually not participate in more advanced rounds because you concentrate on the creation phase. In angel groups, you continue to invest sometimes, and you use some personal time. If you're special purpose vehicles, you usually just network with the lead or the general manager, exactly in the same way of a VC fund. But the special purpose vehicle is limited to one company, which is high risk, and the limited partner at VC funds is focusing on a group of companies. So that is the main difference. And then we have a VC club that is very lean too, where you can just participate and make your own decision, but it's a hybrid that doesn't exist. So why is now a great time to be an angel investor? Well, the first thing is because everybody's going through a reality check. What do you want to do with your life? What do entrepreneurs want to do with their lives? Their clients are going through a reality check too. What is really important to them? So right now, during the coronavirus crisis, people are concentrating on the real basics, the structure of the deal, the structure of the value. What is the team? How do you maximize that? And because these companies are so young, they're very, very versatile. They don't have the baggage of all these processes in place. They're creating the reality. So they're fresh, they're young, they are invigorated. Now we see more deals. You know, in terms of crisis, the amount of entrepreneurial activity goes up because sometimes you don't have a choice, but sometimes it's because you say, well, if I want to have some security in my job and I might be laid off, I might as well do it for myself and influence the outcome of my work in my life. So we see more and more deals. We have better short-term deals too, because entrepreneurs know that there's very little capital available, especially in later stages. Those are the ones that are suffering, the ones that are going IPO. Those are the ones that are suffering, the ones that are, you know, raising 40, 60, 100, $1 billion or are going IPO. Those are the ones that are suffering. But the early stages, you have short-term deals because they want to close the round. In reality, an entrepreneur is raising money or is executing. But it's very hard for the entrepreneur to be constantly having meetings and meetings and meetings trying to close the deal. They want to get the money and get to work. They need to get to work. They need their team to be working. They need to sit down with their clients because the reality is changing for everybody. So they want to have a shorter term deal. They want to close it faster. And then they say, you know, in 6 months or in 10 months, I'll come back and look for more money. But I'm not sure which way I'm going to go because everything is changing so rapidly. And the other benefit is that the cost of pretty much everything has come down. So they get better deals as well. So they're realizing, I don't need that much money. I already had my reality check. Maybe I don't need to do this expense now. People don't care that much how you look. Everybody's working from home. And that transcends into everything. We're redefining how pretty our brochure looks. So all of these things are influencing the way we do business. And these entrepreneurs, they want to get to work. So they say, okay, I'm going to give you a discount. I'm going to give you a benefit. But I need a response in a shorter period of time because I need to get to work. I need to go and take care of my company and my employees and my users or clients. Also, now is a time where you can give them more support because they're open to listening to you because everybody is going through an immense period of transformation. So now is a time where you can tell them, hey, I'm going to meet with you every month, or let's have a call every month to see how we can influence your outcome. So they're very open to that. They're also very open to innovation because they have to adapt very quickly. And to be honest, most of us don't know how we're going to live, how we're going to react, what we're going to do. And they, in their struggle to create a new business model, they're very, they don't have a preconceived notion of how things have to be or not. So you are, you're participating in that circle of innovation, and you also get contaminated by that. So that is why now, during a crisis, is the best time to be an angel investor, because you are so incredibly active and so incredibly useful, not only because of your money, but because of all the other things that you can do. And this is a historic moment. This is what I wanted to leave you with. In few years, you will talk about what you did during the coronavirus pandemic. We would say to people, you know, we stayed indoors, we thought about life, we were scared, we lost money, we had to pivot, everybody sucked, you know, people didn't know what to do, the kids, everybody was having video Zooms with the kids around, we didn't know how to eat, the stores were closed, everybody was wearing masks, there's a lot of people that were dying, we were all suffering. But you can also say, you know what? That historic moment was the moment that prompted me to consider being more active and being an angel investor. And I started taking angel investing seriously. I started talking to others. I learned. I went to see webinars and things like this. And Coursera has great things. I bought books. I talked to other angel investors. I found companies that I wanted to support. I went to the local companies and I said, you know, how can I support you in a way that we both create a new reality that is not a pity or a donation? It's because I believe in you and I want you to be a great company. How I took action, how I saved some jobs, how I became a better person financially, intellectually, and spiritually. That is why this is a historic moment. It's not because it's a crisis. It's because how we reacted to the crisis. And that's why I think angel investing should be in the top of your head. If you have the capacity to invest, do so, start doing it during this crisis, because it will be very useful to you and to others. And what is angel investing about? It's about diversification, but it's also about impact, the impact that you can have and the return that you can have. So we're here to support you in that process if you need support. We're here to teach, to invest, to coach. Go to our website, wealthing.com. Make sure that you ask our questions down here or in the YouTube channel. And I hope that I've encouraged you to consider angel investing, because it's one of the most engaging and rewarding professions that I can think of. This is Alicia Castillo-Holly. Thank you for listening, and we hope to see you at Wealthing. John.